I can show, see my screen, and then we good to go. Just like a little nudge. Yeah, I'm assuming y'all see it. Let me know if you don't. Boom. All right, so first of all, I want to get directly into the information. We're going to be more direct this time, more to the point this time, and more on topic. I'm going to try to riff less. So we're going to start out with why multifamily other over investment types, because you can go into warehouses, office space, a lot of things you can do. So number one, you can go with a FHA loan, which is a very unique opportunity to secure an income producing property for 3.5% down. If you were to try to do this traditionally with a conventional or DSCR loan, you're gonna have to put anywhere from 20% to 25%, sometimes 30% down. And you have to think about the big jump that is on, say, a $400,000 property. 3.5% down payment is much more manageable and accessible than 20%. When looking at these properties, you're gonna wonder to yourself, how would I qualify for something of this price? Because the prices are up there. Well, as long as it's actively rented, 75% of that property's income gets credited to your income when it comes to qualifying for the loan. That's how they see how big you can go. You do still have ratios that the lender's going to talk to you about. So anything from 2 to 4 units is going to be a residential income producing property, which will allow you to go FHA. The thing to note is if you try to purchase a single family house, a townhouse, a duplex, a single family house, a townhouse, a villa, something like that, you cannot go FHA, mainly because you're not allowed to generate income from any part of the property if it's not a multifamily. And that includes a single family with an efficiency. So that's worth noting. There's a very high volume of deals. So in South Florida, especially, it's a global market. So for years, for decades to now, people have been transacting in multifamily properties, no matter what's going on in the market. For example, if you were getting into office space and COVID comes around again, I don't believe people stopped renting apartments or had to move out of their apartments because of COVID, but a lot of people had to leave their offices. So just something to think about. When I say it's easier to get started than commercial, it's just to say you may not understand restaurant businesses. So it may not be best or ideal for me to try to sell you a restaurant to rent out because when the tenant's calling about their grease trap, you're gonna be like, what's a grease trap? Um, so outside of that, it's scalable, proven wealth building route, and I'm gonna show you how we build wealth through multifamily. So here's how I analyze a deal. We getting right into the advanced stuff. You can start taking notes and we gonna know how to do stuff right after this class. So I start by looking at the listing, whether it be from MLS or Crexy or CoStar, wherever it is. I read the listing in entirety. I want to know what the tax roll says. I want to know what the zoning says. It can be in my face pictures of a fourplex, but then when I look at the, oh, sorry, when I look at the, I gotta add people. When I look at the MLS or the tax roll in depth, it tells me that it's really zoned single family. So if it's set up as a fourplex, but it's a single family house legally, then we got a defect on our hands. It's not, you can't just set up a property however you want. So we need to make sure the use is in line with what we're trying to do. More on that in another class because we're splitting it up now. We're not riffing. So I look at the current rents to see what each unit is paying now, and then I'm gonna go back to MLS and do a market analysis on rental properties in that area. So if we're buying a multifamily like a fourplex in this city, I'm not gonna compare it to the rents of if it's a 3-2 single family house or a 3-2 condo. I want to compare it to what people are paying for other 3-2s in multifamily properties like this. It has to be close, it has to be recent. So we're getting the most accurate picture of what market rents is and what we can expect to raise our value to. So as far as the taxes on the listing, you're gonna see it says last year's taxes. That's because taxes are paid in arrears. So which means it's paid the year after. So the way you don't get caught up because you will buy a property by what the taxes says now and you're doing your numbers on that, but then next year the tax doubles or triples or quadruples. In most counties like Broward County, bcpa.net is how you would look at the taxes on any property, but there's an estimator there. You just click tax estimator and you put in the city, the zip code, and how much you plan to pay for that property, and it'll tell you what your taxes might be. So you need to know your numbers before you get into this because you will be stuck. Let's see. So I run a cap rate. I don't want to go too deep into this and kill all your time, but we run a cap rate, and what that is just a snapshot of the market so I can see how this property is performing. For example, the higher the cap rate, the bigger the profit margin, but theoretically, the more it's kind of like a way to gauge risk. So, for example, if I have a triplex in Weston and the purchase price equates out to be a 6% cap rate, that's a 6% return on the money you put, the price you pay for it. And another property in another city has a 7% cap rate for the same price. It's telling me that this one over here is going to make you more on your money than this one over here. It's not just about the rents, it's expenses goes into this. So another thing. The DSCR numbers, what I'm saying there is, so a DSCR loan is a debt coverage service ratio loan. Another topic for another class. Don't try to remember it. Essentially, I'm making sure that with the mortgage payment included in these expenses, is there still money left over for this to have made sense? So if the property makes good money on its own, but you need a mortgage to purchase it, it still needs to factor for that money. So this is all about really just knowing the systems and knowing what to look for and knowing, you know, it's data entry at a certain point. Once you know what all you need to get from a property, it's just getting that data and putting it into your little spreadsheet or whatever you make. So, when you're looking at a deal, I also want to see, are there any add value opportunities? So are the rents under market from when I looked at it? Is there a way to reduce the expenses? For example, if it doesn't have impact windows, then they may not be getting a discount on their insurance that they can be getting. So if I can do that and get the insurance costs down, I just kind of open up my margins a bit. So that's what it's all about. Looking at the snapshot of the property, looking at the area of the property, how the market is doing, and just knowing your add value opportunities to make the deal work for you. I need water after that. That was a big slide. Mm. Okay, now when it comes to looking at a deal and analyzing its expenses, how do you know you're really getting an ideal picture on how much the property generates after expenses? All the listing probably says is this is the rent, or this is what you could rent it for. So the ideal expenses you're gonna probably assume on most any property you're gonna encounter is gonna be they're gonna have property taxes. Even if the current property doesn't have insurance, you want to budget for insurance. It's all about minimizing liability as well. You don't want to have a property and then a hurricane comes and the roof's gone and now you got to replace three roofs because you bought three. You just budget for insurance and make sure it fits the numbers before you even get into it. Utilities. Does the property owner have to pay for water on this? If the property has separate meters and the owner is paying for water, an add value opportunity would be tell the tenants you guys pay your own water, but obviously you have to do it when the lease expires. I'll try not to give you too much information on each topic. Okay, so repairs and maintenance, you're not gonna really know exactly how much it's gonna cost to fix this property every month, but on average, we would like to just budget 10% to have to the side, or you can kind of look at the T12, the past 12 months of expenses the owner actually did have to pay and kind of guesstimate and see where consistencies may be. Uh, you're not always going to have to do pest care, lawn care associations, especially in multifamily. But on the topic of lawn care, if it's a multifamily, like a duplex, triplex, or fourplex, you're going to have a hard time getting a tenant to cover lawn care. If it's a single family house, it's a bit more reasonable to have the tenant cover it. And in all of these, you can't just put it at the maximum rent and then say tenant pay all of the expenses. You want to look at the comparables and see at these rent prices what is included in rent for these people. It all matters. It's all research and data entry. Where it says right here, vacancy loss, that is you're just kind of budgeting in time for your tenants to not pay rent, your tenants to pay late, a tenant to move out and you got a vacant unit. It's not always going to happen, but you just want to budget 10% of the time for that to happen. So essentially, all of this is once you take how much money that property is expected to generate a month and multiply it by 12, that is how much that property might make in a year, which is called our gross income. So when you take these expenses and subtract it from that gross income, you now have our net operating income. That's just advanced math I just taught you how to do right there. So once you have your net operating income, you can divide that by the asking price of this property to see what the cap rate is. And depending on who your client is or your goals, you have that target cap rate you're looking for. So I have investors right now, and we're looking for at least a 6% return on our money for it to make sense for us. I have another person, his goal is units. He wants at least 20 units for it to make sense. And for that, he's willing to accept a lower cap rate, maybe five. But if you do that calculation and the cap rate you get is under what you're willing to take, then now you need to say, well, what price does it need to be at to get the cap rate I want? Because if I need a 7% cap rate, but my calculations are telling me this property at this price and these expenses is a five, something needs to give. So we can either try to get the price down to be seven or close to a seven, or look for add value opportunities to see, can we raise the rent a little higher? Can we lower the expenses a bit and make it a seven that way a bit after closing? The thing is, and then year after year, you're gonna renew these leases, and then they're gonna renew higher and higher. But just as rents are improving, we're assuming just overall value is improving, but we're also factoring that expenses are gonna go up as well. So this is all research and data entry. So I'm here to show you the systems, which is what this is really all about, to keep this going and build some wealth. How to reach market rents, because you can't just buy a property that's under market rents and turn it around and put it on the market and say, give me market rents. They won't do it. It has to stand up to the competition. So when I'm doing comps, I'm going a step deeper. I need to see the pictures. Is it weird that I'm looking at this screen, but y'all can't see me? Here, I'm gonna do this. All right, I got you. I got you. I got you. Boom. Boom. Look at that. All right. It's so if the properties in the comparables are getting 2,200 a month and you're buying a property that's currently rented for 1,750, but it's leaking, it needs a bunch of work, it needs a bunch of upgrades, what has to happen for this to look similar to what people are paying 22 for? So hopefully that in a nutshell gave you that. We'll do another like in-depth class, but feel free to stop me and I'll dive deeper on that. Where we at? Okay, charge late fees. A lot of owners are guilty of not charging late fees. Stick to your systems. So if a tenant is coming in and there's going to be something more risky to your income property, for example, they have large dogs that are not considered service animals, and your property doesn't have like a fenced yard, those dogs are going to have to probably be inside the house. And if there is a chance that the property has a certain texture or material that might be affected by large dogs, and just by walking on it or something, you now know the 1 month of a potential security deposit, that's not enough to cover you. So you need to have a additional pet deposit. Maybe your pet deposit is non-refundable because you're kind of expecting to have to fix this certain extra thing. Because this is, I hope this is making sense where I'm going when I like give up on the point because it's seeming too long. Um, in addition, when you charge your late fees, it's a benefit to you, but you don't let it be like a tool of leniency. So if rent is due on the first and late on the fifth, on the sixth, you should send a 3 day notice to that tenant with the late fee included. And if they pay you a partial payment, deduct it from that balance and give them another 3 day notice right after. Now you owe me this, because it now they can't take a month to pay you back. They could keep giving you little payments and payments and payments, sure, but you got the late fee to make it worth having to do that. It all has to make sense numbers wise. Research and data entry. I'm gonna get t-shirts, research and data entry. Um, all right. Every year you want to renew your leases. Some people will have the same tenant in there for 15 years and just never renew them. They're still paying 725 right now. And when it's time to ask them to renew their rents, or you say you want to sell it, they're devastated and they feel like you did something to them because nowhere in a 30-mile radius supports a 750 budget. So you want to stay on top of that. Also, your expenses are going up. Don't forget that. So it makes sense that you do that, but sometimes they're probably just in such bad shape. You want to just kind of do some improvements in exchange for that rent increase so it makes sense. Boom. Oh, when you purchase, oh, this is my favorite one. When you purchase a multifamily property that already has tenants in place, and there were tenants that just have a pending balance because the owner never evicted or never charged a late fee or just let it go, they owe that property some money. They owe that towards the lease. So you as the new owner, go right on over and send a notice. You go right on over and knock on it. Just see if you can work it out and see, can you pay a little over what your rent price is for the next few months so we can work out a balance. We'll start fresh. Whatever you negotiate. This isn't legal advice, but it's just a way that you can collect a little extra money than you would have otherwise. Not on the topic of market rents, but it's all about maximizing. Hmm. Let's see. Ignore this. I want to delete that. Offer Wi-Fi. That's like if you want got a really big building and you want to, compete with 10x living and stuff. What is a 1031 exchange? It's the holy grail, and it's what this is all about. So it is how you defer capital gains legally. So capital gains is if you bought a house for $250,000 a few years ago, and then you sell it for $500,000. Assuming you bought it cash, you made $250,000 in profit. The IRS is going to tax you capital gains tax on that $250,000. So you can imagine that's a really big penny. People don't want to do that. So if you get with an intermediary, because once you sell a property, that money can't go on your account. Once it goes in your account, too late to 1031. Here come these capital gains next year. Um, the money goes to it's like a trust account, if I'm not mistaken, and they hold on to it. And you have 45 days to identify a replacement property. It has to cost at least the same amount or more, or you got to bundle up a bunch of properties together to add up to how much you just made. You got to spend it. Um, from the time you identify it, you got 180 days to close on it. That gives you time to do negotiations, do your due diligence, your research, argue, go back and forth, have it fall through, and put it back together again. You have time to close, but there's no time to mess around. There's no I haven't heard of an extension given, so you want to take it seriously. Um, the tax basis, this is a really important. This is what it's all about. The reason you're gonna do the 1031 exchange is because after a while, the tax depreciation you're using is gonna kind of diminish after you around 10 years. A bunch of stuff's gonna start to break. You're gonna have to do 40-year recertifications, 50-year recertifications. It kind of plateaus in like how much rent you can really get and how much it's really gonna increase. After a while, the money kind of gets stagnant and slows down, and you need a boost because we got goals and we want generational wealth. Mm. So we 1031 it because say between 5 years, 7 years, 10 years, you've built up equity. The rents are now higher. It makes more than it did. The surrounding area is different. And so we sell it, take that equity, hold it into the intermediary. And my flow for 1031s is I'm not gonna have you buy something cash. We're going to use all of that money as 20 to 25% down on a DSCR loan for something now 4 times bigger than what we just sold, and then we do it again. We're gonna stabilize it. We're gonna do our due diligence. We're gonna find the rent increases. We're gonna raise rents. We're gonna add value. And then 5 to 7 years, we're ready. We're ready. Sell them all 1031 exchange. Let's get something with 25% down, which is our buying power, which is now 4 times bigger than that. And now do you see how generational wealth is being built? But keep in mind, you're not just not paying capital gains tax, you're deferring it. So they're pushing it back. And then you got another gain, okay, add it, push it back. So you're building up this really big capital gains tax balance that they're gonna want as soon as you mess up on a 1031 or just sell a property and don't 1031. So what do? I can't remember the step up tax basis, step down. Ask Melinda Grimal. You need an attorney, but I will get the exact actual name. But essentially, it's a process where you can transfer ownership of the property to your heirs without triggering a taxable event. So now that ownership changed, the valuation is now updated, but no capital gains tax was paid because no gain was received. So now your heirs have this big, big, big asset that is 80% bigger than whatever you started with at a fresh slate of tax deferment. Does that make sense? And then they keep the 1031 chain going. So they're going to add value. You built systems. The management companies in place. They're going to run it, run it, run it. 5 to 7 years, they know what the plan is. Sell it. That's 1031. We use this money as 20 to 25% down on something 4 times bigger. And and you're wondering how do you support this? Theoretically, a property for 100,000 considering the income and expenses, and a property for 400,000, considering the income and expenses, assuming they're for the same purpose, shouldn't this one make 4 times more what this one makes? So the numbers work. So it's all about, do the numbers work? Do you know your numbers, and do you respect your systems? So is there more slide after this? Let's see. Bam. This is a client case study. This is real business. This is real big business right here. This is going on. So I sold this client a multifamily property about every 2 years or so. So this is not in order. We bought the duplex, and he put if I'm not mistaken, 40% down on a DSCR loan. That was like around, well, like $200,000, something like that. Two something. A couple of years later, we bought a fourplex. Boom. That is 65% down. That was 25% down on, I don't remember the price. I should have put the prices on here. That would have been smart. This triplex, that is inaccurate. This was not done on an FHA loan. That was like a example. All of these properties were done with 20 to 25% down. Nothing got purchased with under that. But long story short, a duplex, a triplex, a fourplex, we now have 9 units. We accumulated over every 2 years. And why are you able to do that? Because when you bought this duplex and added some value and rents went up and you renewed the leases, well, now it's making more than when you bought it. And it was already purchased to make money. It was cash flowing. And probably you made some more money on your end. And then the property's worth more. So you can get another DSCR loan on another property because you're making it's about cash flow. So the way the DSCR loan works is they want to look at the property's numbers. Do you know the property's numbers? And they want to see, does this property generate enough consistent income to cover the mortgage, the taxes, the insurance, expenses, and a little razzle dazzle on the extra on the end. It's at a 1.1%, 1.1 ratio. Don't ask me to explain that part. Talk to a lender. But essentially, the loan worries about the property's numbers, not yours at that point. You just gotta get there. You have to show that you can manage a rental property. You can, so you gotta start small. Start with your one, and this is how you scale. So let me fast forward. Once we sell these properties, assuming a loan payoff of around 900 something thousand dollars by now, we're gonna walk away with around $1.2 million. So let that sink in. We put 21,000. That's not 21,000. That's a bad number. That's a bad number because it wasn't FHA, so that's not. I'm mad about it's okay. Long story short, imagine what we did pay for this, which, if I'm not mistaken, it came out to around 2 point something million total paid for all of these properties. We're pulling out 1.2. We didn't put in 1.2. We put 20% of that 2 point something. Does it make sense? And we're gonna take the 1.2, and why would I have him buy one property for 1.2? He's gonna get a fourplex. I'm not gonna sell 9 units to get a fourplex, but 1.2 with a DSCR loan, that's 20 to 25% down on 4 million. And for $4 million, I could get you about 15 to 20 units. I could turn your 9 units into 20. I can do it. I know the numbers. Look at the numbers. So now we have something systemizable and replicable with systems in place. So now you just keep going. Where you get these 15 to 20 units, we're going to add value. We're going to raise rents. We're going to stabilize, beautify, and not overdevelop, because we know in 5 to 7 years, we're going to do this again. And where do we go from 20? Do we go to 40? Do we go to 50? Sky's the limit. So, as you see how this works, you built the big business, you 1031 and kick the 1031 can all the way down the line until you die. Okay? Because when you dead, how the government gonna get their taxes? Who owes them taxes? The Exactly. So what you do is you do this step up basis. I'm gonna step up tax basis is what I think is called. But you need a lawyer and someone that specializes in family planning and estate planning, and you step it up to your heirs, to your kids. You have a property management company, you have systems in place. They're gonna take over that cash flow, but they just got to know the systems. You got to trust the systems, build the systems, and teach them the systems so they know the game and how to keep it going. But as you see, all you have to do is start and monitor. What happens is people buy properties, rent it out, and I bought a property, I want to keep it for life. That is a mistake. I bought a property cash because I don't want a mortgage. That is a mistake. Is it about saying you bought it cash, or is it about the numbers? You will make for Theoretically, you will make significantly more using that same amount of money to get 4 to 5 times the amount of property. On an FHA, you're using a little bit of that money to get, what is that, 97.6% the amount of property. So take advantage while you can. You just have to live in one unit for at least a year. You can't move out. Oh, let's book a strategy call. Okay. So if anybody's ready, anybody interested, let me know. I will help you get to your first 1031 exchange. I did this class in 27 minutes. Ain't that all right? I don't want to waste your time. Come on now. Tell everybody big business. Get you in and out the door before quoted. Any questions? That means I did a good job. Okay. I miss Walter. I'm not gonna lie, I miss Walter. But all right, I will reach out to everybody through the next week, see what you thought, get your feedback. I appreciate you guys. And I had a slide with upcoming classes, but I'm doing spin-off classes on everything. So I'm gonna have a class on tax strategies, a class on 1031 exchange in specific, a class on development, ADUs. It's okay. You'll see the announcements. I appreciate you. I'm Khalid. I'm Big Business, the investmentpropertygurus.com. Shout out to you. Thank you and enjoy your night. It's that awkward moment you gotta find it. And